The first level that we're going to look at is the core resistance level, right? So the core resistance is the white green bar that you see at the top. And basically is the price level with the most net gamma when it comes to calls, right? And generally this level is really a level where there is the most upward resistance. And if we look at this chart, like we want to really understand why this could be a reaction zone. So what this represents is really the level or the strike price where we see the highest net call gamma. This also means that a lot of investors have been buying out of the money calls at that strike price. So they are believing that the market could potentially go up to that level, right? So they're buying calls because there's leverage. They want to like monetize that. So they are investing in, they're betting that the market will reach that level. But why does it become a resistance level and a reaction zone? So let's go back to our delta hedging or market makers and market mechanics, right? So we know that the market maker is buying stocks or buying underlying stocks to hedge the call options. So as the spot price close to the core resistance level, then we can see that those calls that were previously out of the money now start to move in the money. The delta also of those calls will change. So at that point, the investor or the trader that were long those out of the money calls, what do? They start closing them because they are making profit. They're making money, they want to monetize these calls. And the reason is very simple. Options have an expiration date. So the more time passes, the more those premium will decay. So if you are an option trader and you bought an out of the money call and suddenly the price moves up and the call is in the money, you want to like take those profits. As a result, they close out the calls, and therefore the market maker also has to close those hedges, so they don't need to hedge anymore, and they will close those long exposure that they had by selling. So that basically triggers then a selling pressure in the underlying asset that then becomes a reaction zone, and that typically stops the price from moving higher that level. So that is where, for example, we're going to see some sort of bounce back. It doesn't mean that the trend is reversed, but you're going to see like a bounce back. And that could be a good opportunity if you are trading, if you want to stop your trade, or if you want to take a reversal trade as well. And then, a lot of people ask, but can the price actually move above this level, right? Can that be done? It's like, yes, of course, it can indeed. We're not predicting the future. We're just trying to give you a statistical advantage, right? So the clear example of that is if we go back to the GameStop saga, right? We see a dramatically increase in price during 2020. And that was mostly driven by the large amount of call option, out of the money call option, and suddenly started becoming in the money. So the market maker was starting to hedge those positions and people were holding. They were not selling those call options. They keep holding, they kept buying more. So that pushed kind of like the market higher. And we saw what is called, a gamma squeeze. So we saw this exponential growth. And the reason is very simple, because the market makers were forced to inject a large amount of liquidity that kept driving the price higher. So this is kind of like how you can kind of leverage this data to your advantage to understand, okay, what is going on in the option market? How is the market maker going to react? And what can you expect from the price action? So the question we get asked is like, okay, how can you use this level for trading? So similar to what you would do in technical analysis, where you have your resistance level, you could call, and the reason why we call it resistance is for the same reason, because we want to simplify how traders can look at this data, but at the same time being able to encompass the power of the option data. So we can use this level as a resistance or reaction zone where the price slows down, and then you see like a pullback, like in this case. So if you are in a long trade, you can use this level as a take profit target. If you are looking for a reversal opportunity, then this could be a great opportunity for you, because you know that there is a market mechanics behind that could have an impact on the stock. The second way of trading this is really as a breakout trade. So this could mean that the core resistance is an inflection point. So if we see a strong break to the upside towards the core resistance level, it means that investors are most likely going to roll up their calls to the next levels, to the next reaction zone. So we might be able to see like a very strong momentum, like in this example. And then the best really example is, let's take a very practical example on Nvidia, right? So at the end of March 2024, so like a few weeks ago. So we are obviously in a strong uptrend, and we are at March 26. The price is approaching the $1,000 mark, right? So here we have the price from TradingView and the net GEX or the net gamma exposure chart from our models as of March 26. And here we can identify, the two main levels, which is the core resistance for the all expiration, so by looking at the whole option chain. And then we also have a core resistance for what we call zero DTEs, but in the case of stocks, it represents the next weekly expiration because they don't really have daily options. So we can highlight the two green bars, which is 950 and 1000. Those are very important reaction zones. And as you can see, the price basically reaches this level and fails to break above it. And suddenly we have a start of like a, kind of like a correction. So this is a very good example on how you could use this level. If you were long on Nvidia, you could have used that as a take profit target. If you wanted to do a reversal trade, you could have used that as like a short opportunity or short trade signal.